Hello, and welcome to myfinancesteacher.org. Between the 1st and 3rd of October, gold price has shot up by about $60. What the hell, my finance teacher? Didn't you say that gold is in the downtrend, possibly into November? Interesting comment here from Christoph. Should we see an update on gold price? How reliable are these cycles? And are we going to see a lower gold price? Is it possible that the cycle doesn't give us much lower prices? I, like Christoph, haven't bought any at 1460 and 1480, and I would like to see a better entry on gold over the next several weeks. So let's have a look at my view on gold. First of all, the reason for this sudden $60 spike in gold price, which was over 4%, is clearly weakness in the stock market. It all started with the weak manufacturing data, followed by this quite significant drop in S&P 500. During that same time period, between the 1st and the 3rd of October, S&P 500 lost nearly 4.5%. However, yesterday the stock market has already regained 38% of that recent decline. In one of the recent videos, we actually mentioned that S&P 500 was knocking on this 50-day moving average and was about to drop deeper. One of the targets was retesting this 200-day moving average, and S&P 500 came relatively close to that. From now on, for a couple of weeks, I expect S&P 500 to stay elevated in expectation of that FOMC meeting this October. So we've likely seen our second daily cycle in stock market completed on the 3rd of October, and whether that was the end of the intermediate cycle remains to be seen. But for now, I want to have a look at more details in gold. So first of all, yes, I should probably have expected some short-term strength in gold in light of possible weakness in the stock market. But I am still convinced we're in the declining phase of this intermediate cycle. And in this video, I'll give you the reasons why I think so. First of all, let's have a look at the longer-term average. This is a 200-day moving average. Currently, the gold price is nearly 10.5% above that 200-day moving average. And the recent low at the very beginning of October was over 7% above that 200-day moving average. Next, let's see how that 200-day moving average relates historically to these intermediate cycle lows, and at the same time we'll try to answer part of the question from the viewer: how reliable are these cycles? Let's look at the history after that significant drop in gold price from 1900. So let's start from early 2014. That's the period where there is a little bit more interaction between gold price, intermediate cycles, and this 200-day moving average. While that bear market in gold price lasted, which I think was happening until the end of 2015, after that significant drop in gold price since 2014, the peaks in intermediate cycles in gold did take place above the 200-day moving average, whereas the lows, intermediate cycle lows, did take place quite significantly below that 200-day moving average. In late 2015, we have this bear market in gold completed. Since then, most of intermediate cycle lows, with only two exceptions, did take place below that 200-day moving average. And the two exceptions we've had so far are here in summer of 2016, as well as last summer this year. Even then, in both of these cases, the gold price at the intermediate cycle low was only around 3% and 1.5% above that 200-day moving average. So for the upcoming intermediate cycle low, even if we do not dip below that 200-day moving average, we should still most likely see gold prices much closer to that 200-day moving average. Even if the gold price doesn't really dip any further within the remaining part of the declining phase all the way into November, before the new intermediate cycle starts with its advancing phase, probably giving us a higher high in the gold price, such a sideways turn in gold price would still help this 200-day moving average to catch up with the price a little bit. That's when one might say, okay, this is a relatively safer entry point based on the duration of this intermediate cycle as well as the proximity of the 200-day moving average. So to answer part of the viewer's question, yes, there is a possibility that gold price doesn't really dip that much lower and just simply kind of goes sideways for a while, and that could be a way to finish the ongoing intermediate cycle. But in my opinion, that's not the most likely way. The reason why it's not the most likely way is, after all, we've seen a really strong rally since May to September. And a lot of people on the market, a lot of investors, a lot of speculators are still too excited about gold, are still too bullish about gold. That's why we do get these comments saying that gold is probably not going to go any lower. But the truth is, intermediate cycle lows do not take place with too much excitement about the gold price. They take place when there is, figuratively speaking, blood on the street. That's the time to buy, right? Look at this decline between April 2018 and August last year. To be honest, within that decline, I entered too early with my average price of somewhere around 1240. And all the way down from 1240 to about 1160, I was getting a lot of comments simply telling me that I was playing wrong. However, the fact is you never know when exactly this intermediate cycle low is going to happen. Look at all of this history. Historically, these cycles take around half a year. So, of course, there is no certainty on the market. You can just look at historical price action and analyze the data and figure out the most likely price levels and time ranges for good, relatively low risk entry points. And even if you did enter at about 1240 in summer of 2018, within the next intermediate cycle advance, you would eventually get into positive territory after, of course, some painful losses. And I do get losses very, very regularly because I do not catch the very bottom of every intermediate cycle. However, when I think it's about time for the intermediate cycle to finish, I start averaging into my positions. And if gold price continues to decline for a short while after that, of course, I do get temporary losses. And moving on forward, I do expect lower gold prices because that 200-day moving average is too far below current price. And if you look at the previous intermediate cycle decline, which was very, very mild, between February and May this year, gold price only lost about 6%. Even then, in such a mild intermediate cycle decline, 14-day RSI came somewhat closer to overbought levels compared to where it was a couple of days ago. So another reason to possibly, nobody knows the future, possibly see lower prices on gold is this large distance between the recent low in RSI and the oversold levels. And lastly, one more reason why I do expect lower gold prices is the price action in gold miners. I noticed that sometimes gold miners actually lead gold price, and while gold price recently has broken above the 50-day moving average, the miners failed to do that. So on the miners, we possibly see kind of a very weak retest of that 50-day moving average from below. And that weak retest, maybe a failed retest of this 50-day moving average, will possibly turn into a decline where GDX will come closer to its 200-day moving average. Whether we're going to dip below that or not, that remains to be seen. But at the moment, I don't really want to enter into GDX at the prices above 27. So in the short term, I still want to be cautious. I still expect lower gold and GDX prices. However, in the very long term, I am actually quite bullish on gold price. I think the next intermediate cycle is going to give us a higher high. And once we are breaking above 1600, that's when possibly more speculators are going to notice that gold has started its run up and they're going to enter the market as well. At the moment, broadly speaking, there aren't that many speculators that are interested in gold. We are probably gold bugs. We're an exception to the general market. Once the general market starts entering into gold price, that's when we are going to see new all-time highs in gold, possibly in another 3 years. After all, for the last decade, all of the central banks in all of the world have printed unimaginable amounts of money. So far, a lot of that money went into the stock markets. Look at S&P 500, look at Nikkei 225, that's the Japanese market. All of those markets are considerably higher than where they were about a decade ago. And if anything happens to the markets, if the next recession hits sometime over the next year, 1 or 2 years, a lot of the money that flowed into the stock market might try to escape into relatively safer assets, including gold. So even if I buy some gold right now, I think in the long term, that should still be not a very bad decision. And that is my view over the next weeks as well as over the next years. Let me know what you guys think. Thanks for your comments. Thanks for your suggestion on nice dividend paying stocks. And Good luck in your trades.